Are you thinking of acquiring a business? If you are, you need to know the financing options available to you. And I'm going to use this video today not only to discuss those financing options, but also to try to provide you with some insight on how the market works and why it works the way that it does. So let's dive right into it. I am going to go to the opposite extreme to start here and talk about large commercial acquisition. Typically loan sizes of 25 million and above, companies with revenues 50, 100 million and higher. These types of transactions get done in the investment banking groups, typically at regional or national banks. And these bankers are super sophisticated. They know how to put into place complex structures, and they do deals that are not fully collateralized. And part of the reason why they can get comfortable with these is, again, because they put very tight controls in place, but also because when you have a company that's got 100 million plus in revenues, even if that company is no longer making money, if you have a lender who's closely watching that company and they're experienced in managing companies and they know when to step in, they can step in and still liquidate a company based on that revenue value. There's still a lot of value to companies with large amounts of revenue. Now, when you switch and go back to buying a small business, which is what we're primarily going to talk about today, small businesses tend to have much lower levels of revenue. $1 million, $10 million, maybe $20 million. There's not a lot to be sold at that point. Usually by the time the deal goes bad, there's not a lot of value there, and there aren't a lot of buyers for small revenue companies. A lender's not going to get back anywhere near what they owe on those companies at that time. Furthermore, when you're doing smaller loans, you typically end up in the business banking group at a small community or regional bank, or the lower middle market lending group. And these lenders are not as sophisticated as the lenders on the investment banking side. And when I say that, I am not being insulting to these lenders. They're smart people, they're good people, they work hard, they know lending inside and out. But the issue is that they're given by their management teams a very defined swim lane to work in. They don't have a lot of options. They need to have deals that are fully collateralized. They need to have deals that have good cash flow, and they need to have deals that have good credit. If they're missing any of those three items, there's not a lot of options for them to move a deal forward. So oftentimes we find a lot of small business bankers, if they have a deal where the business purchase is relying a lot on goodwill and there are not a lot of hard business assets to back up that acquisition, those lenders are typically looking to or almost forced by their bank's policies to use the SBA 7A loan program. So what is the advantage of an SBA 7A loan program? The SBA 7A loan program is a government-backed program that gives a guarantee on 75% of the loan amount that the bank provides you. So if they're doing a loan where maybe the cash flow is a little off, or it is under collateralized and there's not enough hard collateral to back the loan, that government guarantee, in essence, solves that issue for the bank. It gets that small business banker and their management comfortable because now they have that cash flow concern and or collateral concern resolved, and they'll move forward and do the transaction with that government guarantee in place. There are many benefits to using an SBA 7A loan, and I'm not going to go into everything about the SBA loan program now, as we have other videos that talk in more detail about the SBA 7A loan program. But what I do want to do today is discuss why it can be a good program for buying a business. Via the SBA 7A loan program, you can get away with as little as 10% down on a business purchase, and if the seller is willing to carry back 5% or more of the purchase price on a note that's on standby, meaning you can't make any payments to the seller for the life of the SBA loan, you can get away with as little as 5% down on your purchase. That's very little money down on a business acquisition. The other benefits of an SBA 7A loan is that you can get a 10-year fully amortizing loan term for just a business acquisition only. If you're buying the business and real estate, if the real estate is more than 50% of the purchase price, you can get a 25-year amortization on the entire debt. If it's less than 50%, the bank can do a blended amortization. Well, they'll lend you based on 10 years on the business purchase, 25 years on the real estate purchase, and blend it, and you'll end up with an amortization somewhere between 10 and 17 and a half years on the business acquisition. Why is this so good? Well, when you get a blended amortization, it's usually going to mean between a 10 and 20% savings in your monthly payments versus financing both separately. That blended amortization really pushes out the business acquisition term debt and works to your advantage as far as your payments and your cash flow needs going forward. Other benefits with the SBA 7A loan program is you can get down to a 1.25 debt service coverage ratio and qualifications. And the other big benefit that nobody talks about that I think is very important is that there's typically no loan covenants or ongoing conditions with an SBA loan. Meaning, so long as you're making your payments and you haven't really defaulted on the loan, or you haven't had a major change in ownership, or you haven't had a death of a guarantor, there's really not much that could cause that loan to come due. They can't say you missed some sort of ratio or you didn't make money and now they're going to call your loan. Your loan's pretty much good for that 10 to 25 year loan term so long as you're making your payments. A couple disadvantages of the SBA 7A loan program is anybody with a 20% or greater ownership does have to guarantee the loan. And you have to do a full buyout of the seller. The seller cannot stay involved in the transaction post-closing. As far as the equity that comes to the table for the acquisition, it can be buyer equity, or you can have investors that own less than a 20% interest that put in the equity for the deal. And the amount of equity they put in does not have to match the ownership interest you give them. You can have somebody that you give a 5% ownership interest in the company put in 100% of the equity on the transaction. The SBA identifies that you as the owner who are taking on the risk of the guarantee on a majority of the loan to support that purchase price should get compensated for that risk. And if you continue to maintain a 95% ownership interest while you only get 5% away for the equity, that is acceptable to the SBA and the lenders. The last big benefit of an SBA 7A loan is you do not have to have the loan fully secured. So if you do a transaction that's largely based on goodwill, we can do an SBA loan up to 1,000% or higher loan to value, meaning you don't have to have hard collateral. Now, if you are short on hard collateral, the SBA requires the lender to look at any guarantor, and again, that's anybody who owns 20% or more of the business, and see if they have outside assets that could help shore up the collateral shortfall. Oftentimes, those assets will be found in equity in a home, equity investment properties, or maybe some sort of non-retirement brokerage account that's not part of the equity going into the transaction. What the lender will do, and what they're required to do by SBA standards, is take those assets as additional collateral on the loan. However, don't worry. If you don't have the assets, there's nothing for them to take, and they won't take them. So it can still be non-fully secured loan. So don't worry, even if you don't have outside assets to back the loan, you can still do the loan. You'll still be covered by the SBA. So now let's talk about structures of deals that don't meet the SBA requirements. That may be a deal where the seller's staying on, so you're only partially buying in the company and the seller's rolling equity. Or that may be a deal that gets over the $5 million limit. One thing I didn't mention before is that there is a $5 million limit to what you can do on an SBA 7A loan. So if you're buying a business for more than $6-7 million after the equity going in, the SBA 7A product may not work for you. There is an exception to that, which I'll talk about in a minute. So if you are looking at a business and you need to use a product that's not SBA, there are lenders that treat the market similar to the way larger banks do on the investment banking side and will do the loans on a conventional side. However, what you have to understand is that there's nowhere near as many lenders as there are on the investment banking side and as there are on the SBA side that fill kind of this gap in transactions from 5 million to 25 million in size. So there's not as many options and it can be harder to get these loans done. So what are the typical parameters these lenders are looking for? Typically, they will finance between 60 and 70% of the acquisition costs for the business. So this is going to require a much larger piece of equity than the SBA requires. You're typically looking at 30 to 40% in equity. Furthermore, typically they don't want to advance more than a 2 to 3 times multiple of adjusted EBITDA on the business purchase. So if you're buying a business for a 6 and 7 time multiple, they're going to hold back what they advance to 2 to 3 times. In essence, that lender doesn't want to get over advanced on the goodwill value of that business that you're paying a high premium for. So it can make it harder to get deals done that are being sold at a really high multiple. Unlike on the SBA side, where you're somewhat limited in the equity you can bring to the table, on this side, unlike an SBA loan where you're somewhat limited to the equity you can bring to the table, on the commercial loan side, you have many more options. So you can do true equity, you can do seller rollover, you can do mezzanine debt, you can do seller debt. There's a lot of options you can utilize to make up that equity piece. The other big disadvantage to a conventional loan is that you're typically looking at a 5 to 7 year loan term versus the 10-year loan term offered on the SBA 7A loan product. The reason the loan term is shorter is because lenders are trying to get the debt repaid quicker because they don't want that exposure to the goodwill side of the business. 5 to 7 years is substantially less. You're typically going to see 5 years for a goodwill heavy business and up to 7 years for a deal that has more fixed assets, equipment, inventory, receivables, things that the lender can rely upon, which will make them comfortable to lend for a longer term. Most lenders are also still looking for personal guarantees for primary owners. Unless you're a big hedge fund or you have a lot of outside capital backing you or really low loan to value or loan to cost, a lot of times these lenders still will look for personal guarantees from primary owners. So don't think just because you're going conventional, you're going to avoid the guarantee requirements that you have with the SBA loan. However, on the commercial side, those guarantee requirements are not as firm and they don't require you to pledge outside assets like you can have in an SBA loan. Two other major differences with conventional financing. First, the debt service coverage most conventional lenders are looking for is a 1.5 times. So it's substantially more than the 1.25 times on the SBA side. Also, you're almost always going to see covenants in a conventional deal. Typical covenants is a debt service coverage ratio covenant. You're also going to probably see a minimum tangible net worth, which is required to grow over time. So in essence, they're going to restrict distributions out of the company. And you may even see an excess cash flow recapture where a certain amount of profit over a certain level is required by the lender to be used to accelerate the principal pay down on the loan. These are all things that can be negotiated, but they are items you're typically going to see in conventional financing. Now, if you are looking at a business purchase that's over the 5 million SBA limit, but isn't really more than 10 million, you do have an alternative SBA option. A handful of SBA lenders will do what they call a pari passu structure, which I like to refer to as an A and B note structure, where you actually get two loans from the lender. You get an SBA loan for up to $5 million under the standard SBA terms, and then the bank does a second note that matches the terms of the SBA loan for the difference. And typically we can get up to a total of 7 to 9 million in debt between an A and B note structure. So this will allow you to borrow more money utilizing the SBA program. What you do have to understand though is lenders have higher and tighter criteria for doing an A and B note structure than they do for doing a standard SBA 7A loan. And the reason for this is the bank is taking a lot of risk on that secondary loan or that B note. Typically, banks are going to require 1.5 time debt service coverage in an A and B note structure. They're also going to look for stronger historical cash flow from the business and typically stronger guarantors. They're not going to take as much risk on because they don't have the government guarantee on that B note. But using an A and B note structure is an option for purchases that are above the 5 million SBA limit, but typically not higher than 10 million. Now, outside of SBA and conventional bank financing, there are two other financing options. They're used a lot less often, but I do want to mention them shortly here. The first one is asset-based loans. There are plenty of lenders out there that will lend directly on the assets of a business, like accounts receivable and inventory and equipment. The biggest challenge with doing this type of loan that a lot of borrowers forget is no lender is going to lend 100% of the value of those assets. Let's use equipment as an example. If you have $2 million worth of equipment value, the lender is going to require an appraisal on that equipment, and they're going to lend off of a liquidation value appraisal. So if the market value of the equipment's $1 million, the liquidation value is probably somewhere between 80 and 90% of that market value. So that equipment of $1 million is going to get discounted to 80% down to maybe $800,000. Then on top of that, most equipment lenders are only going to lend 75 or 80% of the liquidation value of the equipment. So that $800,000 value is going to get reduced even more. So you're going to only be able to borrow 30 to 40% of the value of that equipment. The same thing applies to accounts receivable. Lenders are only going to lend on good accounts receivable that are current. Typically, that means they're aged less than 90 days and that are with good quality customers. They're not going to lend to customers that have a big history of not paying their AR. So you need to consider the advance rates against this collateral when trying to get an asset-based loan. Now, if you're bringing a lot of equity to the table, an asset-based loan may work because you can use the advance rates and still have enough collateral. But I often find people coming to me trying to do an asset-based loan and not put any equity into the deal, and typically it just doesn't work. Very few sellers are going to sell you a business for less than the value of the assets in that business, which is what you would need to happen after lender advance rates to make a deal work. The last option available is there are some lenders that are cash flow lenders. There are some that are banks, but there's a lot of non-bank cash flow lenders. These are lenders that will look to do a deal based on the company cash flow, more so than based on hard fixed assets. Similar to what a commercial bank will do is that they're going to advance a much lower loan to cost, typically again between 50 and 65% of the cost to acquire the company. So you're going to need to bring significantly more equity to the table, or get the seller to roll over a big piece of the equity, or get the seller to carry a big piece of the debt via seller note. But if you can make that happen, there are non-bank lenders that will lend based on cash flow. Typically, you're going to see loan terms between 3 and 7 years. Oftentimes, there's a balloon where maybe the loan will only be good for 3 years, but payments will be based off of 7 years. And really what that lender's looking to do is have you refinance it at the end of 3 years into conventional financing or some alternative financing. But there are cash flow lenders out there, and it is an option we can look at, but it doesn't necessarily work for everybody. Here at Commercial Lending X, we do about 24 business acquisition deals a year. We know the insides and out, whether you're going SBA or whether you're going conventional financing. We can bring every solution to the table and help you manage the process to get through it quicker and get the best rate and terms and the best outcome for you. We love the opportunity to work with you on your business acquisition. Please reach out to us at any time.